Hi there, this is Dusty Wetton, tax attorney at Tax Debt Services. Today's video is about the partial payment installment agreement at the IRS. Alright, so we've talked a lot about payment plans lately with the IRS. Now when you have tax debt, you need to go to a practitioner and talk about all of your options that are available, provide all of the facts that you have, and make sure they have a good understanding of what's going on with the IRS, or do an initial call to the IRS to find out more. Now once you have enough information, you really want to go through all of your options. Is an offer and compromise available? Is it currently not collectible? Is it an installment agreement? And by going through all of this, one of the options that might fall through the cracks is a partial payment installment agreement. We call this a PPIA here. Now a PPIA means that you can pay the IRS, all right? You can afford monthly payments. However, the collection statute expiration date is going to come up sooner than you pay the full debt off, all right? Remember, tax debt does expire. It has 10 years from the date of assessment. Now that 10 years does move, there's tolling, there's extensions, so use a practitioner to find out exactly how much is left on your debt and when it will expire, and maybe the PPIA is available to you. Now we talked about payment plans before. One of the payment plans that we talked about was a financial-based installment agreement. A PPIA is a financial-based installment agreement. You do have to give them a call, fill out forms, provide substantiation, bank statements, pay stubs, mortgage statements, utility bills. You're trying to show them your exact financial picture, all right? You want to get the exact remaining income after you pay all your bills. And by doing this, you want to prove to the IRS, if I pay X amount every single month, I will not full pay the debt before it expires. Okay? That means that some debt will fall off. Give you an example here. Let's say you owe $20,000 to the IRS and your remaining income is something like $160,000. And there's 10 years left on your statute, all right? And you don't have the ability to full pay the IRS, but you go on a payment plan like that, you'll pay less than the $20,000 owed to the IRS. You'll pay something around $19,000 as long as things remain the same. Okay, and that's an important point. You cannot owe again to the IRS, all right? You have to fix whatever mistake got you here and make sure that you make changes so that new balances don't come up. You also don't want to owe again to default the payment plan that you just arranged. Defaulting can happen if you owe a new balance or you miss a return. You have to stay compliant with your tax filings. Okay, so you've proven to the IRS you have no remaining income to pay this full debt off, right? There's some remaining income, you can pay something, but you can't full pay it. Well, why not do an offer and compromise? Remember, an offer and compromise has a maximum disposable income that you have to be under, just like a PPIA. So it seems like it would make sense to do an offer instead, but sometimes an offer isn't on the table, meaning that you might have assets there that are larger than your tax debt. You own a couple of houses, you have some retirement accounts, something that might be there that IRS can use to calculate an offer that's too high for you to qualify. A PPIA might be a good plan B. Or perhaps you owe, let's say, over $200,000 in tax debt, and the calculations on an offer and compromise is just too large that you just can't afford that. Even though the calculations say you can, perhaps it's just not possible for you to do so. Again, a PPIA might be better then. Now this is complicated, so again, I recommend talking to a practitioner, a licensed professional, to make sure you find the best solution for yourself. Same truth here with a currently not collectible. All right, remember, a currently not collectible is a program there for people in a financial hardship. If you're not having enough to make monthly payments to pay this debt off in full, you only have so much remaining income, you're probably in a financial hardship. However, a currently not collectible requires no remaining income. You pay your bills, there's nothing left over for the IRS. That is different than this situation. A PPIA has some ability to pay the IRS $50 a month, $120 a month, a low amount, but you're not going to be able to go on a currently not collectible if you show that you have $50 left over, right? That's not how a currently not collectible works. Again, talk to a practitioner. In summarizing, remember, a partial payment plan means that you can pay the IRS something, you just can't pay them in full before the debt expires. Now, if that is your situation, please do look into it. It might be best for you to go on that kind of plan, but you have to do it right. If you go on a streamlined payment plan, but you might qualify for a PPIA, you're losing money, all right? You want to prove to the IRS that you only have so much left over. And if that's your truth, if that's your reality, and you can prove it, the IRS most likely will listen. Now, for more questions about this or to see if this is the right option for you, give us a call, 800-822-4122, or go to our website, www.taxdebtservices.com. Thank you.